Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for chapter 2 of our principles of, excuse me, not principles of accounting, accounting for payroll, or our payroll accounting textbook. And so I know we've already gotten a little practice with some of these calculations, and we'll continue to get practice with them over the next couple weeks. But I just wanted to kind of point out some of the other concepts or law issues that are covered in the textbook. So I am going to share my screen with you and get that pulled up. We'll go over this together here. Okay, so chapter 2, computing wages and salaries. So just like we've talked about in class together, chapter 2, we're really focusing on just calculating gross wages, right? So gross wages being the combination of regular wages and overtime wages are gross wages, right? And so we're not really getting any practice with calculating like the FICA, Social Security, the FICA Medicare, the unemployment, we're not getting practice calculating those things in this chapter. We're just getting practice calculating, like we said, gross wages. So regular wages plus overtime wages. All right, so some of our learning objectives of this chapter: explain the major provisions of the Fair Labor Standards Act. We are going to go through these as we continue through the PowerPoint, but some of these provisions include the minimum wage provision, the overtime pay provision, the exemption, both, exempt employees versus non-exempt employees, the equal pay for equal work provision, the child labor law provisions, and then some of the penalties and violations. And then describing hours worked. This relates to the different types of activities that are considered principal activities, and then preliminary or post-preliminary activities. Number 3, describe the main types of records used in calculating or collecting payroll data. So timesheets, time cards, and then some of the different computerized record systems that we'll talk about. And then learning objective 4, calculate regular and overtime pay. Again, we've gotten some practice with this already, but we'll continue to get more practice with it in class together. And then learning objective 5, identifying distinctive compensation plans. So for example, salaried non-exempt employees, fluctuating work weeks, piece rate plans, commission plans, different things like that we'll talk about as we go through the PowerPoint. All right, so the Fair Labor Standards Act, there's basically 2 types of coverage. It's either the enterprise coverage or coverage of the company itself, and then the individual employee coverage. So just like it shows here, enterprise coverage includes all employees, working for a company or covered by a company in which there are 2 or more working in interstate commerce. So that's state to state. With at least 500,000 of annual gross sales. And then nonprofits, and the nonprofits could include, hospitals, nursing homes, institutions for the mentally ill, schools for mental or physical, mentally or physically handicapped or gifted children, preschools, elementary, secondary schools, institutes of higher education, public agencies. So in these nonprofit examples, even if annual sales fall below, 500,000, for example, they are still covered under the Fair Labor Standards Act. And then individual employee coverage. So if the company, if they're not covered under the enterprise coverage part of FLSA, they could also be covered under the individual employee coverage. So this includes occupations closely related or directly essential to the production of goods for interstate commerce. So like delivery drivers, for example, is one of the examples they give us. So individual employee coverage kicks in when businesses do not necessarily meet the enterprise coverage test, but these employees are still protected under the FLSA wage clause and coverages. So, again, it gives us that example, driver for a fleet that transports goods interstate from state to state with annual revenues equal to 225,000. Again, annual revenues of 225,000, the company wouldn't necessarily qualify or wouldn't necessarily fall under that enterprise coverage part, but because those jobs are closely related or directly essential to the production of goods for interstate commerce, then those employees are still covered under FLSA. And then just like it shows here, federal wage and hour law prohibits or provides for both these types of coverages. And as we're going to see as we continue through this chapter and through the PowerPoint, many family businesses are exempt, not only because they fall under or, they're under that annual gross sales threshold, but in some other farm situations and things like that, family businesses are exempt. All right, so employer versus employee. So an employer is an individual who acts directly/indirectly in the interest of an employer in relation to an employee. So just like your book tells us, employers could include like co-owners who control the day-to-day operations of the business, would be considered employees, and these individuals are wholly or fully liable for any violations of the law. An individual is an employee if he or she performs services in a covered employment. And so just like your book tells us, this common law relationship has to exist. And basically, the common law relationship exists when the employer has the right to control both what work will be done and how the work will be done. And so just like it says here, specific rules applies to employees of corporations, domestic employees, interns, partners in the partnership, statutory employees. This is all covered basically on pages 3 and 4 of chapter 2. But just like it shows, and I'm just going to briefly talk about each one of them. So employees of a corporation, managers, superintendents, supervisors, department heads, all officers like the president, vice president, secretary, treasurer are all considered employees of the corporation. With partnership, partners are generally are not considered employees of the partnership, but rather employers of the partnership. Domestic employees, these include like cooks, butlers, maids, caretakers, nannies, gardeners, chauffeurs, things like that. Interns, obviously we've all heard of internships before. I know as business and accounting students, all of you have to do an internship. With the intern, volunteer interns who do not expect compensation are generally exempt from FLSA requirements. And then statutory employees. And again, we'll continue to talk about these more as we continue through the PowerPoint slide. Statutory employees are workers that could qualify as independent contractors, but are still taxed as employees for Social Security and other taxes like that. Some examples of this would be like commission drivers, industrial home workers, full-time life insurance agents, full-time traveling or city salespeople. And then statutory non-employees, these include direct sellers or licensed real estate agents. And for federal tax purposes, these individuals are considered self-employed. So you know, if you think about self-employed individuals, they don't get taxes taken out of their check necessarily. They have to file the appropriate tax returns at the end of the year to determine how much they need to pay in. And so when we're thinking about and we've said this together in class before, I know, and we'll talk about this more as we continue through our book, but you know, we talked about that Social Security, FICA Social Security tax at 6.2%, right? And so employees pay 6.2% and then employers match 6.2%, right? And so 12.4% gets paid in. When the individual is self-employed, they have to pay in the entire 12.4%, right? They don't get, they don't have an employer matching that. That amount. So we talk about that more in chapter 3 when we start getting practice calculating the taxes. All right, so minimum wage includes all rates of pay, commissions, non-discretionary bonuses, non-discretionary being bonuses that are kind of built into the pay plan or the pay scale. Non-discretionary bonuses are bonuses normally based on hours worked, units produced, production efficiency, or work quality. So bonuses that are kind of agreed to beforehand, if you will. On call or differential pay. And I can't remember, I think we did talk about this a little bit in Principles of Accounting, but differential pay, that's like, you know, I had a job when I was young where it was from 7 p.m. till 3:30 a.m. So it was like second shift essentially. And so we got what was called a shift differential. We got paid like, you know, $1.10 more per hour than the people doing our same job on first shift, basically, right? There was a shift differential. And that's normal for like second shift, third shift, overnight workers type things like that. So reasonable cost of housing, meals, and transportation to work. And these have to be for the employee's benefit and voluntary, agreed upon and accepted, basically. Discretionary bonuses. So discretionary bonuses are bonuses that are not agreed upon, announced, or promised before payment. In other words, it's at the discretion of the employer to pay the bonus. So that's not included in an employee's regular rate of pay. And then some of these other types of compensation not included in the regular rate of pay include gifts or rewards for service, payments for profit sharing plans, payments when no work is performed, like vacation, holiday, sick day, jury duty pay, things like that. Guaranteed minimum number of hours paid that are more than the actual hours worked, or vehicle, tool, or uniform allowances. So those are not included in the regular rate of pay. All right, paying less or more than minimum wage. Our current minimum wage based on the Fair Minimum Wage Act of 2007 was $7.25. And I did think it was interesting. Your book told us that, and this is on page 2-4, that the first minimum wage was established in 1938. And it was 25 cents per hour. So a little fun trivia for you there. There are a few exceptions to the minimum wage laws. So a training wage of $4.25 an hour could be paid for the first consecutive 90 days of employment if the newly hired employee is less than 20 years old. Institutes of higher education, retail or service establishment, and farms can employ full-time students at 85% of minimum wage. And there's actually a full list on page 2-4/2-5. But tipped employees are another one, which we're going to talk about more. Student learners may be employed at 75% of the minimum wage if they are participating in a vocational training program. Firms whose principal business is the delivery of letters and messages may employ messengers at not less than 95% of minimum wage. And then persons whose earning capacity is impaired by age, physical or mental deficiency, or injury can be employed at special minimum wage rates, but it has to be authorized and approved through the Department of Labor's wage and hour division. And then situations where wages are higher than federal minimum must be paid. So, in some situations, the employer has to go by, for example, the city ordinance or the state's higher wage, right? So even though the federal minimum wage is $7.25 an hour, if the state minimum wage is $10 an hour, then employers have to pay that $10 an hour, right? So employees of federal contractors, and I think if I'm remembering correctly in your book, it says any federal contractor that is doing business with the government on an annual basis of $100,000 or in contracts or more have to pay a higher than federal minimum wage. And then also, again, if there are states with the higher minimum wage, then the employers have to go by that state minimum wage. So, all right. All right, minimum wage versus living wage. So as we'll see here, and this is shown on, or talked about rather, on page 2-6. So the living wage is generally higher than the minimum wage. And so the living wage is based on, kind of the cost of living in that area or in that city. And so just like it shows here, living wage refers to local ordinances that vary between cities, laws that attempt to keep low wage workers' wages on track with cost of living. 100 plus cities have local laws requiring employees that do business with the government to pay a calculated living wage. And then some states now include private industry in these living wage laws. All right, so tipped employees, and again, we've gotten some practice with these calculations already. We'll continue to get more practice with them as we go through the rest of this chapter and then the remainder of the textbook as well. But tipped employees should have regular tip averages of greater than $30 a month in tips. And so the minimum wage or the minimum tipped wage is $2.13 per hour. And so that's the minimum wage for tip employees, right? $2.13 an hour. But the tip should be at least, or make up at least $5.12 an hour. So if you take the $2.13 that the employer pays minimum wage, plus the tip should make up at least $5.12 an hour. That combines to be that minimum wage, $7.25, right? And so just like it shows here, if we take the $7.25 an hour times 40 hours a week, they should have a minimum of $290 weekly gross pay or gross wages. And so in the case, and I think we got practice with one of these already, doing some of these calculations out of chapter 2, but in the case where the minimum wage, $2.13 per hour, and the tip credit, right, because that's what that, the tip should should equal at least $5.12 an hour. That's the employer tip credit. And so in the case where the per hour plus tips do not equal that, the employer has to pay the difference of that. And so again, we'll get more practice with that and see examples of that as we go through. Service charges like bottle service or room service charges do not count toward the tip credit. These are considered wages. If 75% or more of employees agree, the employer and the IRS can set a predetermined tip rate for different occupations. And so, I don't know if they say, for example, well, standard tip is 20%. So we're going to include a predetermined tip rate of 20% or something like that. You kind of see some of this happen. I know at some restaurants when you have a large group, and a large group being like 8 or more people, they usually just apply, for example, a predetermined 15% tip to the bill. And then you can choose to tip more on top of that. So I've seen that before as well. But in cases of 2 jobs performed by 1 worker, the tip credit would apply to the job that qualifies as tipped employment. All right, so here's our example, a couple examples here. So the first one says, Raquel works 47 hours at Christ Church Bar as a tipped employee. She averages 750 tips per week. If her employer takes the maximum tip credit of $5.12 per hour, Raquel's gross pay will be calculated as follows. And so we see here we'd have the 40 hours times 213, right? That's that minimum wage per hour for tipped employees. Plus we'd have 7 hours of the overtime less the tip credit. So that 1088, that's that 725 minimum wage times 1.5. So 1088 overtime minimum wage. She had 7 hours overtime. So that's the 1088. But then again, we have to subtract that $5.12 tip credit. And so the gross earnings for that employee and what the employer would actually have to pay that employee, 125.52. And so that kind of would be in addition to the tips that she got for that week, right? And so here are another couple examples. So if we reported tips in a week of $43, and so we had 40 hours times 213 per hour, plus the $43 in tips, is that greater than $290? And the answer is no, right? 40 times 213, if we take that, so 40 times 2.13, that equals 2.13, that equals the $85.20 plus 43, that equals $128.20. So again, that's not greater than the 290. So the company would have to pay the difference there. And so 290 minus the 43, the employer would have to pay 247. And then if reported tips on the other side of the spectrum are $1,189, that's well over 290. So then yes, the employer only has to pay that minimum 40 hours times $2.13 minimum tip wage. So, and then just like it shows down here, states tip credit percentages may differ from the federal laws. And then also if employees have to share tips with others, like dishwashers or cooks or whatever, then that tip credit is lost to employers. All right, overtime provisions and exceptions. Again, we've gotten some practice doing these calculations. We'll continue to get practice as we go through the rest of the book and then the rest of the chapter. But when considering overtime, the overtime must be within a 7-day consecutive period. So the work week that is established by corporate policy must be 7 consecutive 24-hour periods. There are some states that require daily overtime over 8 hours. And in fact, a lot of unions also do this, because I know my husband's in the union. And so, even if, for example, he only got a total of 35 hours that week, if he worked over 8 hours in one day, he'd get overtime for the hours worked above 8 for that day. So unions do this as well. So Fair Labor Standards Act sets overtime pay at 1.5 times regular pay. We know that. We've gotten a lot of practice with that already. And then a company could also substitute 1.5 hours off for each overtime hour. And so that's called that compensatory time or comp time, right? So instead of paying overtime at 1.5 times the regular pay, a company can instead give the employee comp time, right? But just like it shows here, must be in the same period. Employer can refuse employees to work, or excuse me, employer can require employees to work overtime. If employees refuse, they can be terminated. There are jobs out there that require mandatory overtime. And so I mentioned before that I worked at a company and it was called Smith Klein Beecham, and it was a lab, and that was the job that I worked. Our hours were 7 p.m. till 3:30 in the morning, but essentially we had to stay there until all of the specimens were processed. So it Smith Klein Beecham was bought out by Quest Diagnostics. So I don't know how many of you have heard of Quest Diagnostics, but many doctors' offices, if you get your blood drawn at the doctor's office, for example, then they send it to Quest Diagnostics to be tested for whatever they're testing for. And so all of the samples come from doctors' offices, and this is located in St. Louis. So all of these samples, and they included, blood and urine and stool and all these different kind of samples, right, would come in from the doctor's offices. And then we would process them as far as determining which department they needed to go to. So enter them in the computer system, create a label for them, and then send them or forward them to the department that's actually going to do the test type thing. So sometimes we had to work later than 3:30 in the morning, right? Sometimes, depending on how busy it was, we were required to work mandatory overtime. And then same thing with, I don't know if I mentioned to you guys or not, Liam had got a job in the Coca-Cola factory last year. And so he worked, and it's right here in Earth City, not too far from where we live. But or not Earth City, I guess right before, it's by like in St. Charles. So not cross the bridge yet, right? Still in St. Charles, but they were required to work mandatory overtime. So if they didn't have all of the pallets loaded onto the trucks, right, they had to stay. So there are situations where employees are required to work overtime. So and then there are also some exemptions to the overtime provisions as it relates to hospital employees, retail or service industry employees, and then employees receiving remedial education. And so on these ones, so hospital employees can enter into an agreement with their employee, or hospitals rather, can enter into an agreement with their employees under which a 14-day period rather than a 7-day work week becomes the basis for computing overtime pay. So basically, it's not, just having over 40 hours in that week. It would be over 80 hours in a 14-day period, if that makes sense to you. And many times with these hospital employees exemptions, it's because hospital employees, and I only know this, I've never worked at an actual hospital, but my cousin is a nurse. And I know the way that her schedule worked out is that she would work 4 12-hour shifts one week, which then would give her 48 hours that week. And then the next week she would work 3 12-hour shifts. And so that would be 36 hours. So 48 plus 36, that puts her at a total of 84 hours. So then the hospital's only paying for the 4 hours overtime as opposed to the whole 8 hours earned that 1 week, right? So she would do like, 4 12-hour shifts one week, and then 3 12-hour shifts the next week, and then 4 12-hour shifts the next week, and so on and so forth, right? So that's kind of a reason that hospitals do that. Employees in service or retail or service industry. On this one, it says that employees in retail or service industries are exempt from the overtime provisions as long as their regular weekly rate of pay, including commissions, is at least 1.5 times the federal minimum wage rate. So as long as these retail or service employees are getting paid more than $10.88 an hour, then they can be not have those overtime provisions apply. And then finally, employees receiving remedial education. So remedial education is like basically education that is designed to provide reading and other basic skills at least an 8th grade level. So remedial being, very low level learning that most people would have gotten in middle school, for example, or at least the early part of high school, freshman, sophomore type thing. So again, remedial education or remedial training is designed to provide reading and other basic skills at least an 8th grade level, or below. So at least 8th grade level. And so the when this type of remedial education is offered by the employers are permitted to work up to 10 hours overtime each week. Employees are permitted to work up to 10 hours overtime each week without receiving overtime compensation. So again, the remedial training does not include specific on the job training, but again, training in literacy and other basic skills to get get the employee up to at least an 8th grade level. All right, exempt versus non-exempt employees. So some of our exempt employees, like it shows here, white collar workers such as executives, administrators, professionals, business owners, highly compensated employees, computer professionals, creative professionals, outside salespeople. This is on page 2-11. These are listed in figure 2-2 on page 2-11. I think the next slide shows us that figure as well. But again, they're, for the most part, they're exempt because they're already in very high paying positions. So, they don't have to worry about following, for example, minimum wage laws and things like that because they're already in very high paying positions. So just like it shows here, must be paid at least $455 a week and paid on a salary basis. A proportionate share of an exempt employee's salary for time actually worked. So instead of paying their full salary amount, we can pay them just a proportion, only the first week of employment or last week of employment. So we got a little bit of practice with this in class together. We had one example. I remember that the person started a new job and then she only worked 2 days out of the 5-day work week. So then she was only paid that 40% proportion, right? We got one like that. We had practice with one like that together. And then blue collar workers or manual workers are always entitled to overtime pay. And so this includes any type of manual labor, police officers, EMTs, firefighters, paramedics, LPNs, which are licensed practical nurses. So some of the differences there between exempt and non-exempt. And this is, again, figure 2-2. This is on page 11 of chapter 2. It just shows you some examples of employees that would be exempt. So executives, administrative professionals, business owners, highly compensated individuals, creative professionals, outside salespeople, computer professionals. Again, generally speaking, these positions are, are well paid, and so they are exempt from the FLSA provisions. Some of those FLSA provisions. All right, the Equal Pay Act. So the Equal Pay Act was amended, Fair Labor Standards Act, to require that men and women performing equal work must receive equal pay. Any employer having workers subject to the minimum pay provisions of the wage and hour law are also then fall under that Equal Pay Act. Also applies to white collar workers and outside salesperson. So even if the white collar worker or outside salesperson is considered exempt, they are still under that umbrella of the Equal Pay Act. And so this prohibits discrimination by paying wages to employees of one sex at a lower rate than those of the opposite sex. And just like it shows here, these differentials, if there is a pay difference between a male and a female doing the same job, they're only allowed if based on seniority, meritocracy or a merit system, or some other type of payment plan, like a piece rate plan that reflects earnings by like quantity or quality of production. Any other factor other than sex, right? So there can be different, you can have a male and a female doing the same job, getting paid different rates per hour, but it has to be for some other reason besides just that, one's a male and one's a female type thing. So, and then just like it shows here, if unlawful pay differential exists, employer must raise the lower rate to equal the higher rate. All right, child labor restrictions. So under the Fair Labor Standards Act, the Secretary of Labor issues regulations to restrict the employment of individuals under the age of 18. So not non-farm occupations. Once an individual equals 16, employees age 16 or 17 may work an unlimited number of hours each week in non-hazardous jobs, right? 14 and 15-year-olds are limited to employment in retail and food/gasoline service with very specific conditions as to hours / employment conditions. So on this one, these individuals are not allowed to work more than 3 hours on a school night. And then I forget, I was trying to find it real quick in your book so I could tell you. Of course, I try to highlight everything I want to refer back to and make sure I point out to you. And now I am not finding it, but I know it's 3 hours per day on a school week. Oh, here it is. So there's a maximum of 3 hours per day, and then 18 hours for the whole week when school is in session. And if school isn't in session, then these individuals could work up to 8 hours in a day, 40 hours in a week. So there are some, provisions like that or some rules like that. So agricultural or farm occupations under the age of 12, employment is generally prohibited with specific conditions. So when, and it shows it here. So kids age 10 and 11 may work as hand harvest laborers outside school hours only between June 1st and October 15th. Again, it talks about this more on page 13 of chapter 2, so 2-13. Children age 12 and 13 may be employed only during hours when school is not in session, provided there is parental consent or the employment is on a farm where the parents are employed. Children age 14 and 15 may be employed, but only during hours when school is not in session. No child under the age of 16 may be employed in a hazardous farm occupation, such as operating large tractors, corn pickers, cotton pickers, grain combines, and feed grinders. So just a few of those things that have to be followed. So employer needs to have certificate of age on file. Violations of child labor provisions can result in serious fines. So, whether it's a birth certificate or whatever the case may be, the employer has to keep that identification or that data on file. Record of baptism, statement on the census records of the Bureau of Indian Affairs, right? So, birth certificate for most of us, but it could be there are some other documents that could be accepted as well. All right, wage theft and penalties. Employees have recourse through states when their employer does not pay them according to the law or misclassifies them. So you have 2 years to sue for pay mistakes and 3 years to sue for willful mistakes. The U.S. government may bring civil or criminal suits against employers who violate the Fair Labor Standards Act. And penalties can result from misclassifying workers, willfully violating wage or hour provisions, or providing false data, and then repeated violations and child labor provision violations. So on page 2-14, it kind of shows what some of these, what some of the ramifications of, or some of the penalties of these. So for example, misclassifying workers, whether it's unintentional or intentional. If it's unintentional, 1.5% of wages paid plus 20% of the employee's Social Security tax. If it's unintentional and they did not file the 1099 or did not provide the 1099 miscellaneous income form, the above penalties are doubled. For example, with the willful violations for the wage and hour provisions, fines are up to $2,014. Unpaid fines can result in court-ordered imprisonment. Providing false data, fines up to $10,000 and imprisonment up to 10 years. Repeated violations, fines up to $10,000 per violation, resulting from a continuous course of conduct. Second offenders can be imprisoned for up to 6 months. And then for child labor provision violations, maximum fine $12,845 if there is not serious injury or death, $58,383 if there is serious injury or death. Willful or repeated violations will cause maximum penalty of $116,766. So again, those are covered, those penalties on page 14 of chapter 2, so 2-14. And then what the Fair Labor Standards Act does not cover. So pay extra for weekend. So employers are not required to, the FLSA does not require employers to pay extra for weekend or holiday work, pay for holidays, vacation, or severance pay, limit the number of hours of work for persons 16 years of age or over, give holidays off, grant vacation time, grant sick leave. So, when you think about, because employers are not required to do these things, they don't have to, right? But to be competitive and to retain good employees, they do sometimes have to offer these things, right? So, most positions, I mean, once you're within, a full-time position and it's more considered like a step in a career rather than just a job. Usually you're given some of these things. You're given some holidays off, paid holidays off. You're given some vacation time, 2 weeks vacation a year, for example. You're given some sick leave, maybe six sick days per year or something like that, right? So to be competitive, employers, many employers offer these different things, although they're not covered under FLSA or not required under the Fair Labor Standards Act. All right, so determining employees' work time. So principal activities require exertion and are required by the employer and for the employer's benefit. So prep at the workstation and in some situations changing in and out of protective gear is part of the work day or part of their work time. Travel when part of a principal work day is also compensated or part of the work time. Idle time and wait time, waiting to provide employer service. Rest periods, 20 minutes or less, should not be deducted from the employee's work time. Meal period, unless employee must perform some task while eating. Meal periods are generally 30 minutes or longer. Work at home for non-exempt employees. Sleep time if required to be on duty. Training sessions with certain caveats, and then waiting for doctor's appointment on site. So remember, if it's training for like remedial training, then they don't have to get paid overtime on that. But in some other cases where, for example, if individual is required to do some type of professional development training, maybe it's a 4-hour training session, that's probably something their employer, right? That would be included in their work time, something their employer would pay them for. All right, non-compensable activities, preliminary and post-preliminary activities. So the Portal to Portal Act defines these activities need not be counted unless customary or contractual. And then they give this example here of checking in and out at the plant. Absences due to illness, tardiness, which could result in docked time. And we got practice with that actually on a couple of the exercises we did together last week, where we looked at, if they clocked in, late, they got docked some time, right? And then just like it shows here, the exception to that, the employee must be paid for fractional parts of an hour. Different courts issue diverse rulings on small increments of time. But just to kind of remind us what we did, because again, we got some practice with this in class together. So, it says employers using time clocks may round starting and stopping times of their employees to the nearest 5 minutes or the nearest 6 minutes, which is 1/10 of an hour, or 15 minutes, a quarter of an hour, right? So it says, however, consistently rounding time down to the nearest 5 minutes or 1/10 or 1/4 of an hour would be a violation, in that employees would not be properly compensated for all the time worked. I guess what, kind of what I go back to, and I know we talked about this a little bit in class, is like with the electronic systems and the electronic systems kind of adding the hours worked all up. I don't even, is there really even a reason to round up or down? I mean, couldn't we just use exact minutes maybe? But, I don't know. It's more customary, to either round up, round down, or go to a quarter of an hour, whatever the case may be. So that's one of the things we did look at and we'll continue to get practice with as we're going through this. All right, some of the records used for timekeeping. So Fair Labor Standard Act requires certain time and pay records to be kept. So time sheets, these are what indicate the arrival and departure time of employees. So the ones we've gotten practice with, we've looked at, morning hours in and out, and then afternoon hours in and out type thing. And then time cards, which record the hours worked, the rate of pay, deductions, and net pay. So we could think about the time cards like the individual employee earning records, really, right? They show all of the hours worked, the rate of pay, the deductions, and net pay for that period. Some of the different systems that are used for recording time and attendance, card generated systems, badge systems, cardless and badgeless systems, and then PC based systems. So The card generated systems, employees use time cards similar to the traditional time cards illustrated earlier. Daily and weekly totals are calculated and printed on the time cards for data entry into the company's computer system. Badge systems, employees are issued plastic laminated badges containing punch holes or having magnetic strips or barcodes. The badges are used with electronic time clocks that collect and store the data, which later become inputted into the computer system. Cardless and badgeless systems, employees enter only their personal identification numbers or PIN numbers on a keypad. And this cardless or badgeless system is similar to the badge system in that it uses the time clocks to collect and store data for transmission and processing by the company's computer system. And then personal computer-based systems, employees swipe their identification cards across barcode readers connected to personal computers for easy recording of time worked. So some of those different systems. And then some of this next generation technology that your book discusses includes touch screen, kiosk, internet, biometrics, like for example, a fingerprint scan or an eye scan, or the IVR, which is the interactive voice response. I know that I have a friend that's a teacher in St. Louis. It's the Hazelwood School District, and so the way that they clock on, and right now they're virtual. They're not teaching in person, as most of St. Louis is not teaching in person, right? But um, even when they're in person, they clock in on their phones. So they have an app on their phones, and they log in and they clock in. They clock in through their phones. So there's different ways that it can be done. All right, computing wages slash salaries. Again, we've gotten some practice with this already. We're going to continue to get practice as we go through the remainder of our exercises and the remainder of chapter 2. But the most common pay periods, either weekly, which then are 52 weeks in a year, 40 hours each pay period. Bi-weekly, which is every 2 weeks, basically, then there's 80 hours in a pay period. Or semi-monthly, which is twice a month. And so on semi-monthly, usually it's like you get paid on the 15th and the 30th of the month, or the 15th and the 31st of the month, or you get paid on the 1st of the month and the 15th of the month, right? It's something like that, where it's just twice a month. So semi-monthly. And then monthly, 12 pay periods in a year, then different hours each pay period, because some months have 30 days, some months have 31 days, some months have 28 days, or whatever the case is, right? So there's some differences there. And then just like it shows here, employer may have different pay periods for different groups within the same company. And this is absolutely the case for William Woods. And so faculty, we get paid once per month. So we get paid one time per month, and it's the last day of the month, last working day of the month. So for example, here in January, January 31st falls on a Sunday, right? So our pay period, we actually got paid on Friday the 29th, right? So we get paid the last working day of the month. Basically. And so, however, administrative people at William Wood, so like people that work in financial aid and the business office and admissions and some of those administrative offices, they get paid, but basically semi-monthly or twice a month, right? So it is a little bit different. And then I want to say student workers, it's the same thing. They get paid semi-monthly, although I'll have to ask when we're in class if any of you have had student employee positions where if that's true. I believe that's how it works, but I know definitely for faculty we only get paid once a month. And actually, when I was at Lindenwood, Lindenwood was the same way. They only paid faculty one time a month. So I'm assuming that's a pretty common theme for faculty, teaching faculty at universities. All right, so calculating overtime pay, there are two methods. We've talked about both of these before. And in fact, if you had me for principles of accounting, we got a lot of practice calculating this as well. So the most common method is to take basically 40 hours times the regular rate of pay, and then take any hours in addition to 40. Say we work 48, for example, then we would take our 8 hours in addition times the regular rate times 1.5 to get that overtime rate. So that's one way to do it. We'll continue to get practice with that as we continue through our book. The other way to do it is if we take all hours times the regular rate, and then we take only the overtime hours times the overtime premium. And so if, again, using the example, if we worked, and I think it might show us an example on the next slide, but if we work 48 hours, we make $10 an hour. We would take 48 times 10, and then we would take 8 times just the overtime premium, which would be an extra $5 type thing. So again, we've done it both ways before. We got practice both ways before. We'll continue to get practice both ways as we go through and do more of these together. But here are some examples. So the first one, it says Oshiko. And so this is about how we can calculate gross pay. So again, let me back up for a minute. When we talk about calculating overtime pay, there are two different ways to calculate overtime, right? The two different methods. But then if we think about calculating gross pay, remember, gross is our regular plus our overtime, right? So gross pay, regular plus overtime pay. So it's going to show us a few different methods that we can use to calculate gross pay. And so this one says Ashiko worked for Tinto Inc. in two capacities. Job A paid $14.50 an hour. He worked 37 hours at job A. And then job B paid $11 an hour, and he worked 6 hours at job B. So 37 plus 6, he worked a total of 43 hours or 3 hours overtime, right? So the first method, we can pay overtime at the higher rate. In other words, we can base his overtime on the $14.50 per hour. So we can pay overtime at the higher rate, and we can see kind of how that calculates here. So regular pay, $14.50 an hour times 37 hours, plus $11 an hour times 6 hours. That gives us that regular pay. And then the overtime premium, again, based on that higher rate, $14.50 times 0.5, that gives us that overtime premium. And then we take that times the 3 hours overtime, and we add those two together. That gives us gross pay, or total pay, of $624.25. Method 2, we would calculate total earnings for all jobs, divide by total hours worked to get the hourly rate, and then take 1/2 of this rate multiplied by the overtime hours. So, looking at that same regular pay, and again, we calculated that by taking 14.5 times 37 hours, 11 times 6 hours. That gave us that regular pay of $602.50. And so if we take that $602.50 divided by 43 hours, that gives us a regular rate of $14.01 per hour. And then we base our overtime premium on that $14.01 per hour. So in this case, we'd end up with gross wages, $623.53. Method 3, we use an overtime rate based on the rate for the job performed after the 40th hour. So if we completed job A first, and that one we worked 37 hours, then we moved on to job B, and that one we worked 11 hours. Job B is technically when we went overtime. So then we would base our overtime rate on job B's rate, if that makes sense. So, again, looking at that same regular pay, but then to calculate overtime, we would base that overtime rate on the $11 per hour job B rate. Because again, this individual, Ashiko, was working on job B when he technically started on overtime hours, if that makes sense. So again, a few different ways it can be calculated. You can see that there's a little bit of a difference, not really more than $5 difference, between method one and method three, and really less than $1 difference between method one and method two. So not too much of a variance, but a little bit of a difference nonetheless. All right, so steps for converting period wage rates into hourly rates. So, depending on how they give us the information, we might have to go through all 5 of these steps. We might only have to go through 2 or 3 of them, or 3 or 4 of them, or whatever, right? So first we want to calculate the annual salary. And again, this could already be given to us, or, they could tell us, for example, that, we make $1,000 a week salary. So then to annualize that, we would have to take $1,000 a week times 52, right? That's how we would annualize that. Once we have the annual salary, we divide by 52 weeks to calculate the regular weekly gross. Once we have it divided into weeks, we divide by 40 hours to get it into an hourly rate. And then once we have that hourly rate, we can calculate the overtime rate, right? And then again, the combination of regular plus overtime equals our gross pay, right? So our regular pay plus OT equals our gross pay. All right. I know we've gotten some practice calculating that. Again, I know you've heard me say it a million times, but we'll continue to get more practice as we go through the rest of this chapter, and then also our subsequent chapters as well. All right, so here's an example. It says, salary quoted to Farron, a non-exempt employee, is $1,500 per month. He is paid weekly and has 43 hours in one pay period. So even though he has a monthly salary, he is still eligible for overtime. And so calculate his gross pay. So again, we know what it is per month. We want to annualize it. So we want to take 1,500 times 12. That's 18,000 annual pay. And then we take that 18,000 divided by 52 weeks in a year. That gives us 346.15 per week. And then once we have that 346.15 per week, we can divide by 40, which gives us our hourly rate. Once we have that hourly rate, we can calculate what is our overtime rate. So 8.65 times 1.5, 1298 overtime rate. And then we can take our regular pay plus our overtime pay to get our $385.09 gross pay, right? Here's another example. It says salary quoted to Eve, a non-exempt employee, is $2,000 per month. She is paid semi-monthly. So semi-monthly means twice per month. Okay, so that's when I said, like, usually you would say, like, they get paid on the 1st of the month and the 15th of the month, for example, or they get paid on the 15th and the 30th, for example, twice a month, right? So, and worked 4 hours of overtime in one pay period. So again, it's 2,000 a month. We want to put that into an annual number. We want to annualize that. So 2,000 times 12, that's 24,000 annually. And then we take that 24,000 divided by the number of pay periods for her. Since it's semi-monthly, that's 24 pay periods a year. So that breaks down to $1,000 basically per pay period. And then we can take that 24,000 divided by 52 to get to a weekly rate. Once we have that weekly rate, we can take the 461.54 divided by 40 to get to a regular hourly rate. From there, we can calculate overtime rate and then add that regular 1,000 per pay period, plus that overtime rate, 1,731 times the 4 hours of overtime to get our gross. So When we think about regular wages are based off those semi-monthly $1,000 semi-monthly gross pay. But then when we calculate overtime, overtime is based on, you know, breaking it down per week and then per hour, like we've done before. Here's another example. It says salary quoted to Chi, a non-exempt employee, is $2,200 per month. She's paid bi-weekly and worked 11 and a half overtime in one pay period. Okay, so bi-weekly means every other week. And so if you think about, there's 52 weeks in a year, 52 divided by 2, bi-weekly, there's 26 pay periods in a year, right? So again, first we want to annualize this. So it's an annual salary of 26,400. And then we want to divide that into our bi-weekly pay period. So 26,400 divided by 26, that's our bi-weekly regular pay, right? And then to calculate the overtime, we want to break it down per hour. So then we would take that 26,400 divided by 52 weeks. That gives us that 507.69 per week. And then we want to take that 507.69 per week, divide that by 40 to get our regular hourly rate. And again, once we have that regularly hourly rate, we can calculate the overtime rate and then add up the total gross wages, regular plus overtime, right? All right, salaried or non-exempt employees, salaried non-exempt employees. This one says salary quoted to Felicia, a non-exempt employee, is $1,600 per month for 35 hours work week, paid semi-monthly. Overtime is calculated as regular hourly pay between 35 and 40 hours per week, 1.5 hours, 1.5 after 40 hours. Of 16 hours of overtime in one pay period, 6 hours are over 40 hours weekly. So this person's only going to get paid overtime for the 6 hours that were actually over 40 hours. Otherwise, you know, even though she has a normal 35-hour work week, she's still going to get paid her regular amount for up to 40 hours. Anything over 40 would be the overtime amount. And so that's what we'll see here. So we want to annualize this. So 1,600 per month times 12 months gives us annual salary of 19,200. And this person is paid semi-monthly, which means 2 times per month. So then we take that 19,200 divided by 24. That gives us the 800 regular pay in the pay period, right? The 800 semi-monthly gross. And then to calculate the overtime, again, we're taking the 19,200 divided by 52 weeks. That gives us that weekly rate. And then we take that weekly rate, 369.23, divided by 35 hours, because that's her normal working hours. And so her regular rate is $10.55 per hour. We take that times 1.5, that gives us the overtime rate. So when calculating gross, she's got her regular semi-monthly gross, that's for 35 hours. And then she's going to get paid an additional, because she worked what? She worked 16 hours of overtime, but only 6 are actually over 40. So for 10 hours, she's getting paid her regular rate of $10.55. And then for the 6 hours, she's getting paid that overtime rate to arrive at that $1,048 gross. All right, salaried non-exempt employees that have a fluctuating work week. And so just like it shows here, employee and employer may forge an agreement that a fluctuating schedule on a fixed salary is acceptable. And in this case, just like it shows here, overtime is calculated by dividing normal salary by total hours worked. And then an extra 0.5 overtime premium is paid for all hours worked. So in that example, and it shows us these examples in your book. I forgot, let's see, I forgot to put the page number down here, hot dog, but I did copy these numbers out of your book just to be able to show you an example. This is on page 26. So chapter 2, page 26 or 2-26. But on this one, if we're calculating it this way, so we're taking the $739.20 divided by 48 hours, that gives us $15.40 per hour. And so I forgot to type this in, but it tells us in the book, Matt Leonard earned $739.20 a week with fluctuating work week hours. If he worked 48 hours in 1 week, his gross pay would be calculated as follows. So again, they earned $739.20 divided by 48 hours. That gives us our per hour rate. And then we're taking that $739.20 plus the 8 hours overtime, time and a half to arrive at that $800.80, right? And then the other way that it shows us to calculate this, it says we can divide the fixed salary by 40 hours and then add the extra 0.5 overtime premium, which, as you can see, results in, about $12 something extra pay, doing it that way. And then the BELO plan, or this alternative plan, it says an alternative salary method to compensate employees working fluctuating schedules. It is a more restrictive plan than the fluctuating work week method, and following conditions must be met. So to use this BELO plan, we'd have to have irregular work hours as nature or part of our job. There are large variations in weekly hours above and below 40 hours. Rate of pay cannot include additional forms of compensation like bonuses and commissions, etc. Guaranteed compensation cannot be for more than 60 hours. Beyond 60 hours requires 1 and 1.5 times the regular rate. Agreement must exist between the employer and the employee. So just like it says in our book on page 27 or page 2, chapter 2, page 27, 2-27, it says basically the salary is figured by calculating the wages for the maximum number of hours at straight time and then adding 50% or 1/2 of the regular rate for the overtime hours. So again, there is an alternate less commonly used BELO method, right? The piece rate, again, if you had me for principles of accounting, we've got plenty practice with this piece rate system. Just like it shows here, the piece rate system is used for workers that are paid according to their output. Fair Labor Standards Act requires piecework earners to get paid for non-productive time as well. So even when there's idle time on the assembly line, for example, they still have to get paid for that non-productive time. Must equal minimum wage with overtime calculated either by using method A or method B. With method A, just like it's showing here, we take the number of units produced times the unit piece rate. That gives us our regular earnings. We take the regular earnings divided by total hours to get the hourly rate, and then that hourly rate times 0.5 or times half to calculate the overtime premium. And so to get our gross, then we're taking regular earnings plus overtime to get our gross. So, we're just basing it on a per unit system or a piece rate system, right? Method B, we take the units produced in 40 hours times the piece rate, and then we add that to units produced in overtime times 1.5 the piece rate to get gross pay. It shows you an example of this on page, at the bottom of page 2-27 or page 27. And then this continues on 227. Okay, I lied. So it actually shows you these two different methods at the bottom of 28 and at the top of 29. So method A at the bottom of 28, and then method B at the top of 29. And with method A, it resulted, like using the examples, the numbers they give us in the book, method A resulted in $602.39 of gross pay. Method B resulted in $601.70. So, literally looking at what, just like 40 plus 30, just like a 70 cents difference, in the example they gave us anyway. So, here are those examples, or here are a couple examples using that piece rate, those piece rate calculations. So it says 4,812 units inspected in 47.25 hour week. 600 of those units produced in extra hours. Mustafa is paid 12 cents per unit. Calculate gross pay using both piece rate methods. So again, method A, we're taking the 4,812 units times that piece rate of 12 cents per unit. And that gives us our regular earnings. And then if we take our regular earnings divided by 47.25 hours, that gives us an hourly rate. And then we use that hourly rate to calculate the overtime premium, right? And so for method B, because even though Mustafa produced 4,812 units, 600 of them were produced in the extra hours. So we're separating those two out. So method B, we're taking 4,212 times the regular piece rate per unit. And then we're taking the other 600 units basically times 18 cents a unit, right? 12 times 1.5, 18 cents a unit for those overtime units. Here's another example. Roizen is paid to inspect shellfish and is paid 0.08 cents or 8 cents per case. Roizen inspected 6,897 cases in 43.5 hours. She inspected 423 cases in overtime. Calculate gross pay using both methods. So again, method A, we're taking the total amount of cases, 6,897, times that regular piece rate, 8 cents per case. That gives us our regular earnings, 551.76. And then to get our hourly rate, we take those regular earnings divided by how many hours she worked. That gives us the 12.68 per hour. And then to get the overtime premium, we take that 12.68 times 0.5. So $6.34 overtime premium. So we take our regular earnings plus the overtime earnings to get gross pay, right? Method B, we're separating out the units produced in overtime. So 423 cases were produced in overtime. So, 6897 minus 423. So only 6,474 cases are paid at our regular rate. And then the other 423 cases are paid at, 8 cents times 1.5 or 12 cents per case, basically is what we're looking at there. All right, special incentive plans. Some piece rate systems can also have these special incentive plans to encourage more production and more efficiency. And so an example of this might be, for example, we're going to make 18 cents a unit, for up to 2,000 units per week. Anything over 2,000, we're going to make 24 cents per unit, maybe between 2,000 and 3,500. And anything over 3,500, we're going to make 36 cents per unit, right? So just an example of how an incentive plan could work with the piece rate system. This could also be applied to individuals that earn a salary, but maybe they have a sales quota. And so if they make sales between, 10 and 15,000, they get paid their normal salary. But if they make sales between 15 and 20, they get a 10% bonus. Or if they make sales between, or 10% commission, whatever. If they make sales between 20 and 25, maybe they get a 15% commission or whatever, right? So it could also work for different types of pay structures, not just piece rate systems, but incentive plans do, have been proven to increase employee motivation and employee production and efficiency. So. Okay, commissions, most, and we said this in class together, for the most part, the most common way that salespeople are paid are a combination of salary plus commissions. But there are people that are paid, or are paid on a commission basis only. And so that could happen. So this one says commission is a stated percentage of revenue paid for each transaction. Numerous ways to apply the commission. So with a base salary or standalone. So base salary plus commission, that's the most common. But there could be the standalone or pay based on commissions only. Either way is compliant with the FLSA as long as a minimum wage, as long as the minimum wage provisions are met. So as long as the person earns at least $7.25 an hour for 40 hours, which is $2.90 a week, then the wage provisions are met. And so an example of this, it says Sam sold 40,000 of product. His quota is 31,500. He gets 2% in excess of quota, and his annual base salary is 30,000. If he gets paid biweekly, calculate his total gross. So, we want to put this because biweekly means every 2 weeks. So again, 52 weeks in a year divided by 2, that's 26 pay periods a year. So we take our salary, 30,000, divided by 26. That gives us those base earnings of $1,153.85. And then to calculate our commission, we're going to take what his level of sales was minus what the quota is. That gives us the difference, 8,500 in this case, times the 2% commission or 2% sales commission, means he's going to make an extra $170, or he or she, we don't really know, right? Oh, his quota, they say his. Okay, so his quota. All right, so then we take our base earnings plus commission equals our gross earnings. Okay, I think we're about done here. Non-discretionary bonuses. So non-discretionary bonuses are bonuses that, again, are already agreed to ahead of time. These are bonuses that are known in advance or set up as incentives, and then must be added or included in the period covered by the bonus. And so here's our example of that. It says Jamil earns $13.50 per hour and has earned a safety performance bonus of $85. He worked 44 hours this week. What would his gross pay be? Okay. So if we take that $13.50 times 44 hours, that gives us $594 for the week. And then we're adding that $85 bonus, which gets us to $679, right? And so that's our regular pay. And then to figure out our overtime premium, we're taking that 679 divided by 44 hours. That gives us that $15.43 regular rate of pay. The overtime premium is then half that. So we take that $15.43 divided by 0.5 to get the $7.72 overtime rate. And we multiply that by the 4 hours overtime. So to get our total gross pay, we're taking our regular rate, $679, plus our overtime premium, and that gets us to our $709.88 gross pay. Okay, finally, profit sharing plans. So profit sharing plans are plans in which an employee shares in corporate profits, receives a share in the form of either cash payment, profits paid into retirement or savings account, or profits distributed as stock. These payments must meet standards established by the Department of Labor. And let's see, it says standards fixed by the Secretary of Labor are not deemed wages in determining an employee's regular rate of pay for overtime purposes. So anyway, I think that is our last slide. Yeah. Okay. So I just wanted to kind of go over some of the kind of major topics or concepts covered in chapter 2. I know we've already gotten some practice doing the calculations together. Like we said, we'll continue to get practice with those as we go through the next couple weeks. So once you have a chance to view this, just let me know if you guys have any questions, and I will see you in class. Bye-bye, guys.